Hey, what's up, my friend? So in today's training, you will learn a moving average trading strategy that actually works. Because how often have you learned a trading strategy like the moving average and you find out that it doesn't quite work? For example, if you look at this one over here, this is one of the earliest trading strategies that I've traded. I was taught, right, that, this so-called guru told me that, hey, Rayner, when the fast moving average crosses above the slow moving average, you look to buy. So over here, I buy, right, at this price point. And when the fast moving average crosses below the slow moving average, you sell. So I sell over here, right? So when it crosses below, I sell over here. And what I realized is that when the markets get choppy, when it goes into a range market, I encountered losses after losses after losses. Now, I don't want this, right, to happen to you, right? So this is why in today's training, I want to share with you an effective moving average trading strategy. So you don't have to go through, right, the same thing that I did. So specifically today, you will learn, number one, what is the moving average indicator and how does it work? Because this is something that 90% of traders don't even know what it is. They just put it on their chart without knowing what a moving average really is. So I'll break it down to you step by step to what this indicator is about and how does it work. Number two, I will share with you the two biggest mistakes that most traders make when using moving average and how you can avoid it. This will save you a ton of money. Then I'll share with you an effective moving average trading strategy so you can profit in bull and bear markets. And finally, along the way, I'll give you a ton of trading examples so you can master this trading strategy fast. Sounds good? Then let's dive in. So, what is a moving average? So moving average is actually an indicator that calculates the average price over a given period. So let's say, for example, a 5-day moving average. A 5-day moving average will calculate the average price over the last 5 days. So let me illustrate this so you understand it better. It's very simple, really. So if a 5-day moving average, let's say you have a 5 candle on your chart. 1, 2, 3, 4, and 5. And let's say we make things simple, right? Over the last 5 days, right, the price closed at, this one is closed at $1, this one closed at $2, market closed at $3, $4, and $5. So let me ask you, what is the average price over the last 5 days? And if you know math, right, simple basic math, you just take 1 plus 2 plus 3 plus 4 and plus 5. You divide by 5 to get the average, and the answer is 3. So the 5-day moving average in this case, right, is at $3. So we just put in like one dot over here. So you can imagine, right, if the price continues to go higher, this dot will continue to move up higher because the average price is increasing. So let's say price continues to go up higher, higher, higher. The dot gets higher and higher. When you connect the dots, it becomes a line on your chart. So this is why moving average, is like those squiggly line that you see on your chart. It goes up, goes down. So that is in essence, right, what the moving average indicator is all about. So now let me share with you, right, two, right, common mistakes that almost all new traders make when they deal with moving average. Number one, it's this. They use moving average when the market is ranging. Now, why is this a problem? Let me show you. So if you look at this chart over here, you can see this blue line here is the 50-period moving average. Okay, and you'll notice that this market, simply just chop up and down this moving average like a hot knife through butter. It goes up, it comes down, goes up, comes down, goes up, comes down, goes up. It doesn't really respect the moving average at all. It just simply ignores it. So you can imagine that if you are using your moving average to time your entry, maybe when the price breaks above the moving average you buy, you can see that you will suffer consistent losses, right, from this particular market condition. So this is why the first thing to share with you is if the market is trending, or rather the market is ranging, avoid using moving average. Mistake number two is this. Traders are using the moving average indicator when the market isn't respecting it. So what do I mean by this? So yes, the market is trending, but it doesn't mean that you use any Tom, Dick, Harry moving average on your chart. So let me explain. So if you look at this over here, okay, this is a chart of copper. This market is trending, great. But a mistake that many traders make is that they are using the wrong moving average, right, for this particular market condition. So they can use like the 200-period moving average because it's the most watched moving average in the world, right? So-called, most watched moving average, right, indicator in the world. And you can see that in this case, right, if you are using this moving average to time your entry, you can see that there's not much valid entry points to use. And that's because this current market condition, even though it's trending, doesn't respect the 200-period moving average. So now let me show you, right, what I mean by the market respects the moving average indicator. So in this case, I overlay with the 50-period moving average. You can see, do you see the difference? Notice how this moving average, right, is being tested once, then it bounced, tested twice, bounce up higher, 3 times, bounce up higher, 4 times, bounce up higher, and then 5 times over here. So you can see the difference, right, between a market that respects a certain moving average and a market that clearly doesn't respect it at all. So as a quick recap, right, these are the two mistakes, right, that you want to avoid when dealing with moving average. So now the question is, how do you use moving average in your trading? Well, that's what I'm going to share with you right now. I'm going to share with you a moving average trading strategy that you can use to profit in bull and bear markets. Okay, now let me share with you the rules of this moving average trading strategy. First thing first, the market must be in an uptrend because as you've learned, right, moving average indicator, it doesn't work well when the market is ranging. You want to use the moving average when the market is trending higher. Second thing, and this is important, the price respects the 50-period moving average and is about to retest it again. So now at this point, you might be wondering, Rayner, why the 50-period moving average? What is so special about this? So there's nothing special about the 50-period moving average, but the reason why I go with it is because when the market respects the 50-period moving average, the depth of the pullback is usually quite obvious and there's enough time, right, for you to time your entry, compared to, let's say, a shorter term moving average like a 10-period moving average. If the market respects the 10-period moving average, the trend usually looks something like this. It goes up, the pullback is very shallow, and then continues up higher, pulls back, and then continue higher. So in this case, you can see that when the pullback is very shallow, it is very quickly, right, before the price would continue higher. And before you want to buy, right, the next thing you know, the market is already, off higher. It's already bounced off higher. So this is why, it is difficult to react, right, when the pullback is so short. So this is why I prefer to go with the 50-period moving average, where the depth of the pullback is more obvious, where it looks something like this, right? The pullback is more obvious, goes up higher, and then goes up higher. So at this point, you can see that when the pullback is deeper, there's enough time for you to time your entry, right, and to get on board this uptrend. Okay? So now the next thing is, how do you know that a particular market respects the 50-period moving average? Because there's no guarantee that the market will respect the 50 MA, right? You could just slice through it like butter. So this is why I'm looking for at least 2 tests of the 50-period moving average. So let me explain. So let's say, for example, market hits higher, pull back, hits higher, pull back, hits higher, pull back. And when you overlay with the 50-period moving average, it looks something like this, right? Notice the market tested once over here, twice over here. So this is what I mean by 2 tests. When there is at least 2 tests, right, it tells you that there's a good chance this market respects the moving average and you can use the 50-period moving average to help you time your entry. Okay, so now when it comes back and retest the moving average again, we don't want to just blindly hit the buy button. We want to look for another sign, right? Some clues that the market is about to, or rather the buyers are about to push the price higher. So to look for that clue over here, okay, I am looking for a bullish price rejection. I'm looking for buyers, right, to come in and tell me that they are about to take the price up higher. And to look for a bullish price rejection, we can study candlestick patterns, right? Bullish reversal candlestick patterns. And let me explain to you briefly, why I'm using this and how to actually spot this price patterns on your chart. So first thing first is you can look for something called the hammer. So the significance of a hammer goes something like this. This is the opening price of the candlestick. Okay. Then when the price opened, right, the sellers, right, quickly took control and pushed the price down near this low of this candle, of this time period. And then when all looks, gloom and doom, right, the buyers, right, found energy, they found the strength to push the price up higher and finally closing near the highs of the day. So this tells you, right, that the sellers got overwhelmed. At the start of the day, right, the buyers got overwhelmed as the sellers pushed the price down lower. And near the extreme lows, right, where, the buyers got beaten up, when things look gloom and doom, right, they found the strength, they found the courage and pushed the price up higher and finally closing near the highs of the day. So if you look at this candlestick pattern, right, this is a sign of price rejection. This is a sign of rejection of lower prices, right? Notice the price come down, they rejected these lower prices and then reverse up higher. So this is what I call a bullish price rejection. So of course, hammer is not the only way to represent a bullish price rejection. You can use another pattern, what we call the bullish engulfing pattern. And the story is similar. You can see that on this first candle here, price opened at this price point, push the price down lower, closing near the lows of this time period. The next day, or the next candle, the buyers open near the lows and push, right, price up near the highs and even closing, right, above the highs of the previous day. So again, the story behind it is similar, right? Sellers were in control. Okay, then they got overwhelmed by the buyers and finally the price reversed up higher and closed near the highs of this time period. So this is what I mean by, bullish price rejection. So this is what we are looking for, a bullish price rejection. The fourth thing, we are looking to set our stop loss, right, 1 ATR below the swing low. So just to briefly illustrate, it looks something like this. Let's say market is trending up higher. Okay, then let's say you market hits higher, you buy at this point. Okay, when you buy at this point, right, you want to set your stop loss, right, a distance away from this low, right, probably somewhere here. Okay, you don't want to set it smack just under this low because the market sometimes could spike through the lows and then continue higher. So if you set your stop loss just below the low, you might get stopped up prematurely. So usually my stop loss, right, from this low to here, right, is what is 1 ATR. So don't worry, right, I'll share with you how to calculate it later on, how to set your stop loss. But basically this is the idea. We're trying to give our stop loss some buffer so we don't get stopped up prematurely. And finally, right, you can look to take profit just before the nearest swing high. So all along, right, this simply looks something along these lines. Let me just draw how this will look like. We are looking for the market to be in an uptrend. Okay. For the trend, right, for this market to respect the 50-period moving average, so we are looking for at least 2 tests. So over here, we have 1 test and 2 tests. It is coming back here for a third time. So this third test, right, we are looking for a bullish price rejection, which could be in the form of a hammer, like this. Okay, so if that happens, we can enter on the next day open. So our stop loss is 1 ATR below the most recent swing low, which is somewhere about here. Okay, and as for target, we can look to take just before this most recent swing high. So if the price hits up higher, right, we can look to sell, right, just before this most recent swing high. So let me share with you a few chart examples, right, so you can see this trading strategy in action. Okay, now let's do a quick recap, right, to the trading strategy components that you've just learned. And also, you can also use this as a trading checklist if you wish. So first thing first, remember we need a trending market because moving average works best in a trending market. And I explained to you how to actually define the trend. Number 2, once we have a trending market, we want to identify the area of value, and this is where the 50-period moving average can come into play. I shared with you how to actually look for 2 tests, right, to confirm that the market or the trend, right, is respecting the 50-period moving average. Then the third thing is the entry trigger. I shared with you candlestick patterns that you can use to time your entry. For bullish market, you can use, the hammer pattern, the bullish engulfing pattern. In a downtrend, you can use things like the shooting star pattern or the bearish engulfing pattern. And finally, we spoke about exits, right? Where to set your stop loss and where to set your target if the market moves in your favor. So as of right now, I'm going to share with you a few trading examples, right, to see how this trading strategy works, right, when you are, trading the markets. So have a look at this chart over here. You can see over here, first thing first, what is the first thing that we are looking for? Can you remember? Number 1, a trend. And in this case, we have a downtrend. Notice the price making a series of lower highs, lower highs, lower highs, lower highs, and lower lows. Self-explanatory. Number 2, the area of value. So in this case, if you overlay with the 50-period moving average, you will see a few things. Number 1, price tested once, head down lower, second test over here, head down lower, and then we have a third test over here. Great. The 50-period moving average is acting as an area of value. Third thing, do we have a valid entry trigger? And if you recap to the candlestick pattern lessons that we were on, you will be familiar, right, with this pattern. This is what we call a bearish engulfing pattern. This tells you that at one point the buyers, they were bullish, right? Remember, bullish near the highs, and then it closed, right, rather bullishly on this day. The next day, the sellers came in, pushed the price down lower, closing near the lows of the day. So remember, it's kind of like getting A for exams, A for absent. the same meaning over here. So the buyers got overwhelmed, right, and the selling pressure came in and took control. So we have the 3 components here. The trend, we have the area of value. Number 1, we have the trend. Number 2, we have the area of value, which is the 50-period moving average. And then number 3, we have our bearish engulfing pattern. Let's call it BE. Number 4, what is it? The exits. Where do you set your stop loss? What if the market moves against you? So I shared with you the ATR technique. Just find out what's the current ATR value add on to this swing high over here. And I'm guessing it's probably somewhere here. This is where your stop loss should be, right? It's based on some rough estimation. What about targets, right? Remember, we said that when we look for targets in a downtrend, we want to set our take profit level just before the swing low, because this is where potential buying pressure could come in and push the price higher. So we would probably, have our target somewhere about this level over here, right? So this, we can call this TP. Okay, TP. And if you want to look what happens next, right? If you look at the next candle price, we would have, entered on this candle open. Okay, this candle open. We get into a trade, stop loss, target can be set ahead of time, and then watch what happens, right? In this case, of course, this is a cherry pick chart, and this market pretty much went in our favor. And one thing to point out is that any trading strategy that you trade, there will be winners and losers, right? There's no such thing as a 100% winning rate. and stuff like that, right? There will be winners and losers, and it's the same for this particular trading strategy. And I can share with you one loser right now. As you can see, the market, eventually did retest back this area of value that we have over here. Okay, so notice here at this point, market came back into this area of value, and we have this bearish reversal pattern over here. I won't consider this a bearish engulfing pattern as it didn't cover the body of the previous candle, but some traders will look at this entry trigger as a valid trading setup and they will go short, right? Since after all, the sellers, reverse back the more than half of the previous day gains, right? Closing near the lows over here. So some traders will go short on the next day open, and their stop loss again will be the same. 1 ATR above this highs, or somewhere about here. Target could be before the recent swing low, possibly somewhere here. We'll say about here, right? Somewhere about here is their target. And in this case, right, I can just let you know that this trade is probably a losing trade as the market, break out higher. So again, this is to let you know that no trading strategy works all the time and to kind of manage your expectations, right, in the real world of trading. Okay, so moving on, right, let's have a look at another trading example. And by the way, if you're wondering, the previous example is actually the US 30-year bond futures market, and that was the 4-hour time frame. So moving on, this is the dollar against the Chinese yuan. This is a forex market, and this time around we are on the 8-hour time frame. So this is kind of like to show you that this trading strategy, the concepts that I'm sharing with you, right, can be applied across different markets and time frame. So first thing first, right, again, first question, right, number one, the trend. Do we have a valid trend over here? And as you can see, right, the price forming a series of lower lows and lower highs. Lower high, lower high, lower high, and lower lows, as you can see. Trend is towards the downside. Great, we have a downtrend. Number two, area of value. So this is where things is a little bit more interesting. You can see that number one, it's this area of value. It's not as ideal as I would like, because when you overlay with the 50 period moving average, it's not really respecting it to the exact level. Yes, it's an area, and you can see that the area got breached, right, a little bit by quite a number of times, right, over here. Bounce off that 50 MA, another one second time, and a third time, this one by really quite a bit. Okay, then fourth time over here, and then fifth time we are here again. So another thing to point out is that when you are using this area of value concept, right, sometimes you might get multiple areas of value stacking on one another. So in this case, you can see that the 50 period moving average, I would say yes, it's an area of value, not exactly the cleanest one where it bounces off near the exact level, but rather, it whips around that area quite a bit, but still I'll treat this as an area of value. And if you recall the earlier lesson, I said that, when it comes to area of value, you can use different tools for it. You can use support, resistance, trend line, and moving average, and even trend channels, and much more if you wish to. And in this case, right, you can see that this market actually came into this area of resistance as well. Notice over here, I'm going to highlight this level out. Previous support, which became resistance, right? When the price broke below it, become resistance. And then right now it's at this previous area of resistance as well. So we have two areas of value are coming together, the 50 period moving average and this area of resistance. So now area of value clearly, right, has met our criteria. The third thing, what about entry trigger? So if you look into this, right, you'll see, right, that there is some kind of, bearish price rejection over here. We didn't get any red candle. This is what traders would call a dragonfly doji, but in essence you can see that the price, right, rejecting these higher prices over here, and the closing price and the opening price is pretty much at the same level. So this is again, right, a valid entry trigger, that you can use to go short. The main thing that we are looking for is rejection of higher prices, right, in the downtrend. So in this case, we can see, right, rejection of this higher prices over here. This shadow over here, this upper shadow, is in essence, right, telling you that the buyers, right, got overwhelmed by the sellers, and that's how the price, reverse back down towards the opening price of the day. So that's how we get this pattern over here. Next day, the market opened over here. You can look to go short. Now, what about stop loss? So if you recall, stop loss, I like to use the 20 period ATR. So I'll just walk you through this stop loss exercise to just kind of refresh your memory. So what you'll do is you'll pull out the 20 period ATR. The value right now is 0.0155. So find out what's the highest price point over here and add on 0.0155, which is the current ATR value. So if to walk you through this exercise, this high, the point is about $6, 6.5530. Okay, so I'll take 6.5530, 6.5530, and I'll add on 1 ATR. And I can find the 1 ATR value over here, which is 0.01554. And take my trusty calculator out and it gives me 6.553 plus 0.01554, and the answer is 6.5685. 6.5685. So if you're going to sell right on this candle open, your stop loss will be at 6.5685, and I'm just going to use this little tool over here to demarcate my stop loss. Let's change this to, how about red color, so we know it's, stop loss, and the coordinates is at basically the level 5685. Press OK, and there you have it. So this red line over here is your stop loss, and from this point to this point, okay, this distance is in essence 1 ATR as shown over here. So now what about target? So if you recall, in the downtrend we want to set our target right before opposing pressure comes in, before the swing low. So in essence, right, I can see that there is this couple of swing low and this swing low over here. So you want to be conservative, right? I would say somewhere about here, right, would be a good level, right, to consider, taking profits, right, for this particular trading setup. So what's the outcome of this trade? I'm not going to share with you, because the individual outcome from a trade to trade basis is pretty much irrelevant, because in the short run your trading results are random. I want you to take these strategies, these concepts, do the back testing, the forward testing yourself, and see whether it will work for you. Now let's move on to the stock markets, right, and see how this trading strategy, right, can be applied to it as well. So same concept over here. Number one, what is the trend? This market is in an uptrend, series of higher highs and higher lows. Number two, where's the area of value? So as you can see over here, this market, we had one test over here, two tests here, almost, I would say, consider this a third test. Then it break out of this swing high and came back for a fourth test over here. So yet, area of value for this 50 period moving average, clearly this market respects it. And on top of the 50 period moving average, you can see that there is also this, previously it was a swing high, price broke above it, and it retest as swing high, now became a swing low, and then back here again. So actually this is an area of support, right, that is acting as an area of value as well. So the 50 period moving average and this area of support. So multiple factors coming together for your area of value. And then the third thing, is there a valid entry trigger? So if you look at this most recent bar over here, you will see that this market, the previous day, the price closed, right, really bearishly below the 50 period moving average. But the next day, it gapped up higher and pretty much closed right near the highs of the day. So you can see that previous day, wow, the sellers were in control. Woohoo, right? Celebration. Let's celebrate, right? And the next day, the buyers stepped in and pushed the price, right, back to, near the highs, right, of the day. So this is where, suddenly, buying pressure came in, right, and reversed, right, quite a bit of the losses, right, from the previous day. So you can see that, buying pressure is now stepping in. And on top of it, right, we are trading in the direction of the trend from an area of value. So the story here is pretty good. So again, to me, that's a valid entry trigger to go long, as it shows you, bullish price rejection, buyers coming in to push the price up higher. Can see this kind of like a quick reversal up higher. And again, if you can't really, see this, right, a line chart sometimes might be able to help. You just pull out a line chart, you can see that the quick spike, right, it came down and a quick spike up higher. So there you can see that it's kind of like a V like this. So this tells you there is a rejection of lower prices. The market is rejecting these lower prices. So anyway, where was I? So now, stop loss, you should be a pro by now, right? Just pull out your ATR indicator, find out what is the ATR value, take the low over here, -1 ATR, and that is your stop loss. Now, let's talk about target. Where do you want to take profits? So again, in an uptrend, right, you want to take profits before the swing high, because that is where opposing pressure could come in. This is where sellers could come in. So if you look at this, right, this over here to me looks like a swing high, or some of you might call it an area of resistance. So again, I won't recommend putting it $104 or $108, because this is an area on your chart. The price, right, may not get to that level and then reverse earlier. The market could possibly come up higher. Before it reaches this high, it starts to reverse lower. And if you set your target, too optimistically, right, the market will get close, right, to your take profit level, right, only to reverse all your profits, to see all your open profits just, vaporize in front of your eyes. So that's usually what happens, right, when you are too kind of like optimistic with your target. So be a little bit more conservative. If you have seen, or if you can identify the swing high, set it a little bit lower, somewhere around $99 or so, right? That would be a good level to take profits. So again, right, no point sharing with you the outcome of this trade, because the process is what matters. Okay, let's have a look at one more trading example, right, before we move on back to the PowerPoint slides presentation. So again, same thing. Number one, ask yourself, what's the trend of this market? Market is in an uptrend. Number 2, area of value. So at this point, right, I haven't overlaid the 50 MA, so you won't know if the market respects the 50 MA. But from what you can see, right, this over here is an area of value, right? This previous swing high, right, which has now become support, and then the price is back here once again. So we clearly have this support acting as an area of value. And if I were to overlay with the 50 MA, yep, right, pretty much it as well, right? The price has tested the 50 period moving average here once, twice, and now the third time over here. And in fact, it could be even testing more than 3 times now if I go back in time to see the charts. But again, I'm not going to do that, since you pretty much know where I'm coming from. And finally, the last thing, do we have a valid entry trigger? So let me share this with you. You can see over here, yes, we do, right? We notice that over here, price, right, has a gap below the previous day and then closed bullishly higher. So at this point, right, to be honest, I will be hesitant, right, to buy, because after all, the market, the price, this stock, right, has not reclaimed, right, back this area of support, and it has not reclaimed back above the 50 period moving average. So at this point, to be honest, I won't buy yet. I want to see the price, break back above the 50 period moving average and break back above support. That tells me, right, the buyers are really back here, right, with conviction. So that actually happened, right, on the next day, and no doubt when that happened, right, it will seem that I'm actually entering at a later price, and that's perfectly fine with me, because that's kind of like the price I'm paying for quote-unquote confirmation. So when this happened, the price over here has break back above the 50 period moving average and back above this area of support, as you can see over here on this candle. I will now enter on the next day open, which is on this candle over here. So next day market open here, right, and I will enter stop loss 1 ATR below this lows. Again, you're a pro, you know how to do that now. It's probably somewhere at this level. And as for target, remember, we want to set it, right, just before opposing pressure comes in, before they swing high. So I'll say over here, right, is a pretty conservative level for targets. So in this case, what about the outcome of this trade? Okay, I'll just share this outcome with you. This one, right, you can see that the market did eventually get to our target, but it's not exactly the smoothest path to it. So initially our target was here, somewhere about here. Price head up close, then it made a pullback. So some traders who are not comfortable, right, with watching some of their open profits, reverse or get smaller, or even turn back into a small loss, right, they might, exit the trade too early. But if you have a plan and you stick to it, right, in this case, right, it eventually, reach your target over here. So sometimes when you set your profit target, the market won't just, zoom, right, go in one straight line, give you money in the bank, bam, right. It sometimes will pull back, mess with your emotions. And if you have a concrete trading plan in place, if you know where is your stops, where is your target, you can just, kind of let the trade play out the way, it's supposed to be. Okay, so in this case, right, there's a little bit of, sitting on the hands before the price reaches your target. And of course, another way to look at this is that some of you might argue, right, hey, Rayner, at this point when the market makes, a retracement, now at this point, this swing high, right, this is where opposing pressure could now come in. And I agree, yes, this is another level where opposing pressure could come in. So what you want to do is that if you are, a little bit more conservative, you can see how the price reacts at this level. If let's say the price comes up into this level, and then it forms like a shooting star pattern like this. Okay, so in this case, you can take a more proactive approach, right, and say, hey, there's a selling pressure over here. The market could start to reverse from here. I'm perfectly happy to exit my trade at this swing high. If that's the case, that's a perfectly fine thought, right? And I would say that's a good trade nonetheless. Okay, so this is kind of like additional things to share with you, right, when it comes to your trading thought process, because this is actually the thought process that I go through, right, when I'm trading this myself. Now, if you have enjoyed today's training, then you will love, right, this book called Price Action Trading Secrets. This is a 140-page physical, full-color trading book where you'll discover professional price action trading strategies to profit in bull and bear market. So we cover things like, support resistance, how to draw support resistance, how to tell when support will break, candlestick patterns, right, bullish reversal candlestick patterns, bearish reversal candlestick patterns, how to read and understand any different candlestick patterns that you see on your chart without memorizing them. We talk about reversal trading strategies, breakout trading strategies, how to manage your risk so you don't blow up another trading account. You can see the stuff that we are covering all over here. Okay, so if you are interested to get a copy, just go down to priceactiontradingsecrets.com. This is the link above here. Okay, let me just redo this. So the link is, as you can see, is over here. I'll also put a link somewhere below this video so you can see it. And just scroll down to the bottom of this page. You can click this blue button if you want, and you just scroll down, or you scroll down to the bottom of this page, fill in the details, and we will ship the book to you as soon as possible. So when you get your copy of Price Action Trading Secrets today, I will also give you 3 special bonuses. Bonus number 1, you get the PDF version of this book so you can start reading immediately, right, while waiting for your book to arrive. Bonus number 2, you get this position sizing calculator so you can manage your risk, right, and never blow up another trading account. And bonus number 3, you get Part-Time Trading Secrets webinar. So this is a webinar where you will learn, right, how you can become a consistently profitable trader even if you have a full-time job. Okay, so just scroll down to the bottom here, fill in your details, your shipping address, so I can ship this book to you as soon as possible. And also, right, you are protected by my, right, 60 days money back guarantee. So if you have read the book, right, and for whatever reason you don't find any value in this book, no worries, right, just email us, right, at support@tradingwithrayner.com and we'll happily refund you in full. No questions asked. And the best part, you can still keep the bonuses and the book. How's that for being fair? Sounds good? Then go down to priceactiontradingsecrets.com, right? Get your copy of this book. With that said, I wish you good luck, good trading. I will talk to you soon.